Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have a webinar from Ernie Chan titled Factor Models in Practice. Ernie's going to be giving a very detailed look into factor models in the webinar. Factor models are well known among long-term investors who favor stock selection models, but there are some exotic factors from which shorter-term traders can also benefit. Ernie will talk about various factor model techniques and the more exotic factors recently discovered. We'll also be giving away 5 autographed copies of Ernie's newest book titled Algorithmic Trading, Winning Strategies and Their Rationale. If you are wanting to win one of those autographed books, you need to have your BMT username ready. At the end of the presentation, Ernie will ask 5 questions, and if you get the question answered correctly, I will be asking you for your BMT username, and that's how I will get in touch with you after the webinar to get you the autographed book. So please have that ready. The webinar is being recorded like always. I'll post the recording on BMT sometime tomorrow. If you're watching the recording on YouTube, please do us a favor and give it a thumbs up if you like it. Okay, and with all that, I will now turn things over to Ernie. Okay, Ernie, you should see the option to share your screen on the top left of the panel.
Okay, let me make sure that I'm showing the correct screen here. Okay. Are you able to see my presentation?
Yes, we have the Microsoft Word document, so you need to change that.
Let me see. All right, then let's see here. Interesting that I have first selected one screen and now it refused to let me switch to the other one. But anyhow.
Okay, well I can take control back and then we can try it again. Hang on.
All right.
All right, so let me give it back to you.
Okay.
Try it again.
Okay, do you see my presentation?
No, we're still on the MATLAB screen.
Okay, then let me why don't you take control again, and then I will have to go into that menu to select.
Okay.
Okay. Okay, now let me make sure that wondering which one is screen of monitor one. Okay, now this one. Okay. All right, I think that's okay, right? You can
now we've got the PowerPoint. Yep.
All right then. All right, thanks.
All right.
All right, thanks again for the introduction, Mike, and welcome to you, everybody, for coming to my my webinar. For those of you who don't know me, let me run through a quick introduction. I used to work in machine learning at IBM TJ Watson Lab, and before I became a quant researcher and trader for Morgan Stanley, Credit Suisse, and a number of other hedge funds. Currently, I am a principal of QTS Capital Management, which manages a hedge fund as well as separate client accounts. And I also wrote 2 books. One is called Quantitative Trading, and the second one more recently is called Algorithmic Trading, and that's the one that Mike will be giving out at the end of this webinar. And also I have been a blogger. You can find my blog at dbchen.blogspot.com. So without further ado, let's talk about factors. The first question is, why am I interested in factor models lately? The reason has to do with the low volatility in the markets. For traders, low volatility is not good because that generally means that you cannot generate high returns from this short-term trades. Even for the ultra high frequency trader, as you may have read in the media, they are no longer the goose that lay the golden eggs. Basically, they are not churning out cash day in and day out anymore because of this suppressed liquidity and volatility in the market. So does that mean that we should give up as a trader as a result? Of course not. You know, there is a remedy to this, and the remedy is to increase the holding period. You know, the time scale has, as we know, is inversely proportional to volatility. So if the volatility drops, we should increase the natural time scale of our holding period. And for longer holding period trades, factor models are well suited. And you know, that's because that is evidenced by the fact that most long-term investor pension funds and the like are typically using factor models in their stock selection. Now, there's one drawback, of course. You know, you can't have everything. You know, by holding longer period, you do have one drawback, which is that your Sharpe ratio is going to be lower, but that cannot be helped. We just have to suffer this risk. And actually, that ties in to the risk inherent in factor models, and that we will be talking about in a bit. So what is a factor, or there's another term for it, it's called factor loading. Factor and factor loading are two sides of the coins, and of the same coin, and we will talk about you know, what that distinction is in a bit. To a trader, they are just simply any variable that we can use to predict returns. If you think of a linear regression model, you know, you have all these independent variables, and the dependent variable might be future returns. So you can think of any of these independent variables as factors. That's the simplistic the trader way of looking at a factor model. For a finance professor, there is a little bit more technical. That, you know, it's not simply any independent variable, but the only certain independent variable qualify as factor. Now, examples of factors would be, you know, any number in the financial statement of a company or any technical indicator. So things like book-to-market ratio of a company, return on equity, dividend yield, or even simply just the recent one-month return. These are factors, definitely factors, and they are particularly called cross-sectional factor. The reason they're called cross-sectional factor is that, you know, well, first of all, cross-sectional factors are directly observable. You can measure, you know exactly by reading the financial statement what the book-to-market ratio is. And also, they differ for every stock. You know, every stock has a different dividend yield, has a different recent return. So that's what is called cross-sectional. You know, cross-sectional across all the stocks, the factors are different. Now, actually, to be more precise, these are called, you know, whenever you're talking about these kind of cross-sectional factors, they are actually more precisely called factor loadings. You know, they are not called factors, because factors usually mean that they have the units of return, but, you know, certainly book-to-price ratio, book-to-market ratio, or dividend yield, they do not have the dimension of return. So anyhow, they are you know, sometimes called cross-sectional factor because they are observable and they depend on the specific stock. There are other kind of factors, however, besides these cross-sectional factor, and they are things such as macroeconomic variables. And they are called time series factor, by the way. Examples of these macroeconomic variable would be, you know, let's say the return of gold futures, GDP growth, inflation rate, you know, and also these two favorite factors called HML and SMB. HML is the shorthand for high minus low. That is the difference in returns between a portfolio with high book-to-market ratio minus the return of a portfolio with low book-to-market ratio. In other words, this is a value factor. HML return is a value factor. If the high book-to-market stocks outperform low book-to-market stocks, HML will be a large number. So if the market currently values you know, bid up value stock, then HML will be a big number. Otherwise, if the market now favors growth stock, HML will be small or even negative number. Similarly, S&P is small minus big. Small minus big means that is the difference in returns between a portfolio of small cap stocks minus big cap stocks. Okay, so again, if S&P is a small number, that means that the current market favors small caps. If S&P is a negative or very small number, that means that the market currently favors big cap stocks. So these, now HML and S&P are return of two portfolios. They are not returns of a specific stock. Therefore, they are not cross-sectional factor. They are time series factor. They are the same for every stock. But they certainly differ from one time period to another. That's why they're called time series factors. Now, despite the fact that these factors are common among all stock at one snapshot in time, obviously the factor loading with respect to these factors are going to be different for different stocks. So factor loading you can think of is the regression coefficient. In this case, the factor loading is the regression coefficient of a stock's return with respect to these sort of macroeconomic factors. And obviously they're going to be different for different stock, and of course they're also going to be different at different time. So that's the nature. That's sort of an illustration of what the time, factor loading is, and an illustration of the difference between time series and cross-sectional factors. So that's all very good. That just tells us, what sort of this is just a grammar of factor model. It doesn't tell us anything useful as yet. But before we get into anything useful, let's drill down a little bit about why are if I say that basically every variable, every independent variable can be considered a factor, why are they core factors? What's so interesting? That sounds too general. And indeed, the definition I gave earlier is a bit too general. To be more specific, a factor means that this variable will bring both returns and risk to the investor. Now that's the risk part is actually important. For example, if we are looking at the HML factor, that is to say high minus low, high book to market stock portfolio return minus the low book to market stock portfolio return. Now if people are trading on this particular factor, you will typically be buying value stock and shorting growth stocks, because HML is most stocks has a positive, all the HML is typically positive. Okay, so over a long period of time, on average, high book to market stock does outperform low book to market stock. So in general, you should be indeed buying value stock and shorting growth stock. But this, although it will bring you a good return over the long run, it does bring with risk, and the risk is that there are long period of time that this model does suffer drawdown, particularly during financial crisis. So by buying this factor, by trading on this factor, it will bring you long-term return, but severe short-term risk in the form of drawdown during financial crisis. It's like a mean reverting model. Many of you might know that in a mean reverting model, it churn out cash most times, but occasionally when there's a financial crisis, you will just lose a large amount of money. It's also similar to shorting options. Shorting options bring you cash over time, but occasionally you will be severely hurt by major market movement. So that's the same idea. All these factors come with risk, which manifests itself as drawdown. And so, but why is this risk important? The risk is important because they are actually, again, the other side of the coin of returns. The returns are present because of the risk. You can think of it that way, is that if there is no risk, everybody will be piling into this factor. If buying value stock and shorting growth stock is always great, there's no drawdown. Every day you just buy value and short growth is going to generate 10% return a year. Everybody would be doing that, and as a result, this factor will be arbitraged away. So that's the key thing about factor, is that they cannot be easily arbitraged away. The reason they cannot be arbitraged away easily is because it does come with this unpleasant risk. And not every investor, not every trader want to take those risks. For example, I know that shorting options is going to generate cash, but I'm very hesitant to do it because I know that once in a while I will be cleaned out. So even though there is a factor return on options, I consider those periods where I will suffer severe drawdown too much to bear, and therefore I don't trade, I don't short options. Similarly for many other factors, you know that there's return, but you still don't want to take the risk of generating those returns, and therefore those returns are not arbitrage away. And that's the sort of the financial professor reasoning for calling certain predictive variables factors, is that they cannot be arbitrage away due to the risk. And now sometimes, however, that just because they cannot be arbitrage away does not mean, however, that the factor returns will always be positive, because sometimes both the risk and the return will diminish, right? If certain risk can be alleviated by somehow, by maybe a lot of people trading it, that there's no risk anymore, then the return will also diminish, because without risk, no one is interested in the well, without the risk, you should not deserve the return. Arbitrageurs will indeed arbitrage against this model until there's no return. An example would be actually the S&P factor. Traditionally, small cap generate higher return than big cap stock. A portfolio of small cap stock will return higher than the big cap stock, but in the recent 20 years, let's say, this factor become weaker and weaker, and there's no longer much return to generate. And because there's, again, the reason is that there's, again, diminishing risk in holding small cap stocks, especially a portfolio of small cap stocks. So that's the reason why this factor is now pretty much relegated to the dustbin of history, if you might want to say that. Now, okay, so that's the sort of the the fundamentals of factor models. But how do we compute it? Now, again, in computing a factor, programmatically, you have to differentiate between time series and cross-sectional factors. For time series factor, it's actually pretty easy to compute a factor loading. You just take a long return series, as long as you like, 1 year, 2 years, 5 years, 10 years ideally, and then you regress the returns against a macroeconomic factor such as inflation rate, or such as HML returns, or such as some other things. Simple enough, right? Because again, time series factor is the same. The factor is the same for every stock, so it doesn't matter. You can do it one stock at a time. This regression is certainly done one stock at a time. So you take Apple returns and then regress Apple against the HML factor. And the HML factor is the same for Apple and Microsoft and Exxon and Google and whatever stock that you pick. It's the same. It's just that the regression coefficient will be different. Okay, so that's nothing difficult. So you can use this regression coefficient to predict what the Apple return is, if you think that this factor is very useful for predicting Apple's return. Of course, in order for the factor model to be predictive, you have to lag the return by one time step. You have to use yesterday factor to predict tomorrow's return. That is a technical detail, actually, because many of these factors do not change very rapidly. Like inflation rate is not going to change from 1 month to another, except when there's a major change in the economy. So whether you lag it or not is not likely to make a big difference. You can use this month's inflation rate to predict next month's Apple return. Of course, when you're backtesting the model, you do need to lag it, but when you're computing the regression coefficient, the factor loading, it may not be that important to lag it, because the macroeconomic factor does change much slower than the stock return. So that's just a technical detail that I want to point out. Now, all good for the time series factor. What about the cross-sectional factors? Now, as I mentioned, cross-sectional factors are easy to understand because they are observable. All right, it's comparatively easy to understand as opposed to those time series factor, dividend yield, ROE, BOM. They are called factor loadings to be precise, but actually they are easy to understand but not as straightforward to compute. And the reason we'll explain here. Naively, it should be easy. You just take one snapshot in time, let's say t minus 1, and then you regress the one-day return from t minus 1 to t, that is the dependent variable, and you regress it against the factor loadings of all the stocks for that day, for day t minus 1. Right? The factor loadings of the stocks at t minus 1 is observable. They are the ROE, they are the dividend yield, they are the maybe 1 month return. So at t minus 1, all these factor loadings are known, and you're just going to regress in a backtest situation, regress the future one-day return, which is t minus 1 to 1, against this known factor loadings. Sounds easy, then you can get one number out of it. That's crucial, right? In this regression, you are going to get for each factor loading, you are going to get just one regression coefficient, because you're just using. Actually, that's not true. You do get this is a multivariate regression. So for each stock, obviously, you're going to get a somewhat different factor loadings. But the problem with this naive way of running a one-day linear regression is that there's not sufficient data. The factors from one day to another will be very different. So even if you have 500 stocks, you are not going to get enough data to generate a stable factor in this case. So and every day the factor will be different. So one day you will find that it's Apple. If it's if the ROE is high, you might predict a 10% per annualized return. Another day will say that it will be 35%. So it's all very different. It's a very unstable sort of regression system. So the way to deal with this is that you have to aggregate the data, and there are two ways to aggregate data. One way you can aggregate data is that you can aggregate over many periods of history. So instead of just regressing it every day, from t minus 1 to 1 t, and get a regression coefficient out of it, you have to use, even for a cross-sectional model, you have to use a whole recent period to regress it. What that means is that you will tie the regression coefficient, you force the regression coefficient over this whole period to the same number. You don't allow it to vary very much. So actually that's the way to deal with it in the literature. Now that's it's just a little bit of a technicality. So, but interestingly, sometimes we don't even need to use linear regression. So here, let me talk, we go from complicated to simple here. Oftentimes, linear regression, it might sound simple enough, but it still assigns a different weight and different regression coefficient to every stock. And that itself is oftentimes already overfitting, because there is, even though you might be using the procedure I described, just aggregating data over many periods to get a more robust estimate of the linear regression, but sometimes even that is not robust enough. That is still overfitting the model. And you might consider, in this case, you might consider just using the sign of each coefficient. So full weighted magnitude. And you can, how do we use the sign? Well, what that's saying is that you can say, whenever there's a higher than average ROE, we will assign a plus sign to it. So if ROE is high, we expect the return to be high. Well, that's, sounds intuitive, but we can do that for many other factors. So we are going to standardize each factor, first of all, by the mean and standard deviation within the range of variation of these factors, such as how does the dividend yield, what's the mean of dividend yield, what is the standard deviation of dividend yield across the different stock, and then if you think that dividend yield, a high dividend yield portends a high return, you apply a positive sign to that factor. So here's an example. Let's say you are using ROE, B over M, and B over M as two factors for this cross-sectional model. ROE of a stock in an index, let's say, has a mean of 0.6 and standard deviation of 0.4. Book to market ratio of this same stock universe has a mean of 0.1 and standard deviation of 0.5. And let's say Microsoft is in that stock universe, and it currently has ROE of 0.3 and B over M of 0.2, then the way to compute a factor for Microsoft would be very simple in this scheme. You just standardize. You find a standard score for each factor for Microsoft, and then you add the factors with the correct sign. In both cases, we have a positive sign because we believe that in both cases, the factor will lead to a higher than average return, so we add them. If one of them actually anti-correlate with future return, we'll put a negative sign there. Now, do you see a problem with this approach in the context of multivariate linear regression? That's a problem. So let's think about it for a while. This sounds simple enough, but there are situations where this approach doesn't work. For those of you who are, conversant in statistics and particularly linear regression, you'll see a problem. The problem with this approach is that it works very well if the factors themselves are uncorrelated. Or close to uncorrelated. But if the factors themselves are in fact correlated, let's say B over M is correlated with ROE, this particular way of generating a factor will cause problem because the model can be unspecified, can be misspecified. In other words, even though independently the correlation of ROE versus future return is positive, and correlation of BOM with future return is positive. But if you put the two factors together and they have correlation amongst themselves, it might well be the case that the sign of one of them has to be changed, even though individually they should be all positive. But if you put them together in a linear regression model, you might find that the sign actually will be negative for one of them. And so if you do that and force the sign to be positive in our simplistic factor model, the factor model that doesn't care about the magnitude of the regression coefficient, and you fix the regression coefficient to be -1 and +1, you are going to get a misspecified model. So that circumstance is going to happen sometime. But strangely enough, in practice, we don't have to worry too much about that. Now, going simpler and simpler, sometimes even this standardization is not necessary. We don't need to even worry about the standard deviation or the mean of this factor. All you need to do sometimes is just to rank the stocks based on each factor and then add up those rank. Okay, so this has the flavor of, if you are a statistics nerd, you might remember there's a thing called the Spearman rank correlation, and there's a thing called Pearson classical correlation. The Spearman rank correlation is what we are doing now, or more or less. You are using rank instead of the actual magnitude of these, of these factors. And the benefit of doing that is that oftentimes in linear regression, if there's a factor that is an outlier, if a stock has an outlier, it will distort the mean regression coefficient. So the model will be distorted because of just one stock, simply because it has a very large value. Using this kind of ranking method will eliminate outliers, will prevent this kind of outliers from distorting the model. So oftentimes it's a good idea. So that's similar to the Spearman rank correlation, using that rank correlation rather than the Pearson classical correlation. Okay, so alternatively, there's even a simpler way. You don't even have to add up the rank. So when I say adding up the rank, it means that, okay, with this factor, IBM ranks third based on ROE, and then IBM ranks 10th based on dividend yield, and IBM rank 100 based on book to market ratio, let's say, and then you would just add the rank of 3, 7, and 100. Let's say for IBM. That's the way I was imagining when I said that you should add the ranks instead of actually adding the standardized factors. But actually, there's a simpler way. Is that you don't even need to add rank. You can do what we call a multi-sort algorithm. In other words, you first sort a portfolio of stocks with one factor, maybe ROE, and you pick the top and bottom quintile, and then within the top and bottom quintile, you sort them again using a different factor. So that, and you can repeat it as long as there's enough sort to form a portfolio. So after, let's say sorting 3 times using 3 different factors, you can finally pick the top of the top of the top portion of that portfolio to long, and similarly pick the bottom of the bottom of the bottom portion of that portfolio as the short portfolio. And the reason that this works is that you might say, well, hey, but that doesn't actually allow us to predict returns. But our objective as traders is not to predict returns. That we'll leave that to the finance professor to do. As the job of the trader is to generate, trading signals. What do we want to buy? What do we want to short? So this ranking obviously does not produce any expected returns, but it surely will produce a long-short portfolio that you can trade. Okay, so. Interestingly, even though these kind of methods sound very crude and arbitrary, and particularly for the for example, I mentioned in a statistical sense they are biased, because you have ignored the correlation between factors. Actually, the multi-sort algorithm does not ignore the correlation. The correlation of stocks of the factors do not affect the multi-sort algorithm. It does affect the other 2 methods that I've described earlier. So actually, the multi-sort is a standard usage of the of factor models by a lot of academic researchers because of this fact. But even though you use the other 2 methods by ignoring correlation between factors, they are still found to outperform many regression-based methods. And that's not only true in finance, but it's true in many other areas of social science. If you read the book by the famous Nobel Prize economist, Nobel laureate Daniel Kahneman, called Thinking Fast and Slow, you'll see that he mentioned this fact in that book. Okay, so now let's move on to some more sort of juicy stuff. Some of the exotic factors, and these factors are actually something that a shorter-term trader can use. You don't have to be a Warren Buffett to make use of these factors, and you don't have to hold a stock for 5 years in order to benefit from them. You can hold a stock for not 1 minute, not even a day. Probably you can use it for a holding period from a week to several months. So that's actually these are factors that might be useful actually for traders. So the first factor is called variance risk premium. It's the difference between implied volatility and historical volatility. Now, and generally speaking, it was found that high variance risk premium predicts a negative return. Okay, so if the implied vol exceeds historical vol by a lot, you expect negative returns. The second one is called implied skew. Now, the skewness of returns is equal to the difference between the OTM call and put option prices, OTM being out of the money, call and put option. So, and this is again pretty intuitive. It says that if you have an expensive call, that means that high in price. That means that people expect positive return. Option traders expect positive return if the call is more expensive than put. Actually, the variance risk premium is also pretty intuitive, because people, when there's a high implied volatility, that means people expect there's some kind of a major event happening, and typically the major event is not going to be good. So that's why if you have a high implied vol relative to historical vol, people expect bad things to happen. Now, interestingly, if you take a look at what is called implied kurtosis, now implied kurtosis is the difference between the sum of out of the money call and put option price and at the money call and put option price. Interestingly, high implied kurtosis predicts positive return. We would have thought that they would produce negative return because that seems to be similar to variance risk premium. Now we are measuring instead of implied vol, we are measuring implied kurtosis. But volatility and kurtosis are simply the second moment and the fourth moment of returns, right? So they are both symmetric. So why is it that high implied vol generate positive expected return, but high kurtosis, implied kurtosis generate negative expected? High implied kurtosis generate positive return. This seems to be unintuitive. It's a switch of sign. Well, if anybody, now first of all, the research may not be done right. I didn't do this research, but oftentimes they are refuted in the future with more careful understanding. So if anybody can come up with a reason, that'd be great. But we should treat this with a grain of salt. We need to really look carefully at the research to see if this really holds. Okay, but in summary, these three factors are telling us that options traders know best. Okay, so they are all based on option prices, and we are thinking that option traders know more than stock trader. So that's why they're predictive. Another factor that has nothing to do with option traders is the short interest. Now, the question is, does a high short interest produce a high expected return or a low expected return? That actually depends on how exactly do you measure short interest. The sign of this dependence is very much dependent on the precise way you measure short interest. So that's interesting. There are two ways to measure short interest. One way is called the short interest ratio, SIR. A short interest ratio is simply the number of shorted shares of a stock divided by the total shares outstanding. Right? Simple. SIR is a number of shorted shares divided by total shares outstanding. Now, if you use SIR to measure short interest, you'll find that a high SIR will imply a high expected return. Okay, so what that means is a little bit unintuitive. High short interest in this case imply high expected return, or more precisely, high SIR implies high expected return. That's something that actually the blog, CEO Hedge blog mentioned. They show, in particular in 2013, the most shorted stocks all had the best returns. That's a striking chart that you can find on my blog, actually, that reproduced on my blog. The most shorted stock had the best return last year. This year has not been so prominent, but over the longest time period, that is true. The higher the SIR, the higher the expected return. Now, on the other hand, if you measure short interest using a different variable called days to cover, DTC, days to cover is defined as how many days of volume is needed to cover the entire short interest. So let's say suddenly you have a short squeeze and everybody want to get out of the short position. Well, how many days volume is needed for everybody to get out their short position and cover the short? So that's called day to cover, DTC. And if you use DTC as a measure of short interest, interestingly, you get the opposite sign. A high DTC implies a low expected return. So that is more intuitive. If you use DTC as a measure of short interest, you get a more intuitive result, meaning that low short interest generate high return. So in this case, you can interpret it as saying that the short sellers know best, because the short seller is, if there are a lot of short sellers, that means you should expect low return. So interestingly, DTC is more conventional, is more intuitive, and it tells you the short seller know best. But if you measure SIR, you get the opposite. Okay, liquidity is another interesting factor. It turns out that low liquidity generate high future expected return. That may not be so unintuitive. Right now, for example, we are in a low liquidity period, and low liquidity is often accompanied by low volatility, right? Nobody trades, and nobody change hands. So the stocks do not change hands much. And so that the reason they don't change hands is people think that in the future, you get good positive return. So, hold on to what you have. That's the sort of the notion. So one final factor that I want to mention is the new sentiment. New sentiment is a newfangled factor that is generated by natural language processing algorithm. They pass the news feed automatically for each stock and generate a sentiment score assigned to each story about the stock, indicating whether that this story is likely to have a positive or negative price impact. So you add up all the sentiment score for a fixed period of time, and then that would be the aggregate sentiment score for a stock price. And supposedly, based on the research by the company, ravenpack.com, that sell these kind of data and models, they are, if you form a long-short portfolio of stocks by ranking their sentiment score, using sentiment score essentially as a factor, you get pretty good or very good future returns. So, of course, buyers beware, because this is research done by the company itself. The company just sell you this data itself. Anyway, so that's all for the a quick walkthrough of the survey of all these exotic factors. Let me go back to some of the nuances of building a factor model, and these are nuances that actually I touched upon earlier. And that is to say that if you are ranking stock based on a single factor, okay, if you are using a factor model with small number of factors, maybe single factor, maybe just a small handful of factors, beware that the regression coefficient might change when you are running this factor model on two different universes. Whether you are running on small cap universe or large cap universe, the factor regression coefficient, the factor loading sign might change. So that's very interesting in some sense, because it means that, and that's a general phenomenon of building multiple regression model. When a multiple regression model does not have all the factors that are relevant for predicting returns, if you just intentionally leave out some factors, let's say you are only using one factor or two factors instead of using 10 factors that might actually accurately predict the return of a stock, this kind of incomplete model will generate strange regression coefficient. In particular, that's what we see. If the sign of the regression coefficient will change between large cap and small cap stocks. So what do we do in this case? Well, one simple way to do is that you really cannot apply the same factor. So we really have to segregate your stocks. When you're running factor model, do not, if you are using an incomplete factor model, do not mix up large cap and small cap stock. Do not mix up, for instance, even growth stock and value stock. So you have to be very careful in segregating stock. In other words, making sure that some of the important factors are uniform within your universe. Otherwise, it can cause a big problem with your factor model. The second a related nuance is that that is the reason why some factor models do not work on all industry group. And one of the simple factor model that Joe Greenblatt's book talk about, that's the little book that beats the market. You might have heard of his famous little book about the two-factor model. In the two-factor model, they recommend that you all exclude finance stocks and maybe sometimes utility stocks from building a factor model. You might say, why? This is very strange that this is on ad hoc. Well, it's not ad hoc because it's ad hoc, it is ad hoc, but the reason you have to do that is because the factor model is incomplete. You have not included all possible factors. You have not included, let's say, industry factors. You have not, it's the price to pay for having such a simple factor model, that you have to make sure that your universe is very uniform. So some industry group just doesn't work, so you have to exclude them. So that's related to the issue of you have to segregate large cap and small cap or value and growth stock when you don't include the factors that relate to them. So that's a little bit of technical nuance that I want to throw in when you are building a factor model. Anyway, that's I think I have talked enough, and I'm certainly happy to take questions. Before I take questions, let me tell you that I am running my next online workshop on momentum strategies in December. So if you want to sign up, the people do go in, sign up pretty fast. So I limit each online workshop to 6 people. So if you do want to sign up, please go to my website, and do please keep in touch via Twitter, and also by posting comments and questions on my blog. Thank you very much.
All right. Thank you, Ernie. So before we give away the books, let me see if there's any questions. So if you guys have questions, you can go ahead and type them now. Ernie, it was a really great presentation. I think that I will definitely be rewatching that recording a few times for my own personal use. And by the way, I noticed at the top, I'm not sure if you know or not, but about, I don't know, 8 months ago, I finally gave up on retail platforms and I started doing my own thing with Python and R. And I noticed that you're using MATLAB. So I'm just curious what your take is on MATLAB versus R.
Well, I like MATLAB because it is a very user-friendly platform. It has a very great debugger. You can compare multiple arrays side by side, just like an Excel spreadsheet. When you want to examine the content of a variable, you just need to move your cursor, your cursor to that variable, and a JavaScript will immediately pop up to show you what's inside. So there's all kinds of bells and whistles that I find really useful for production, for increasing productivity. Sure. And one historical reason why people prefer R versus MATLAB is they say, well, R is free and MATLAB is expensive. Yeah. That reason is no longer an excuse, because MATLAB is now selling for $150.
Oh, really? Nice. Yeah, I don't know. I guess it kind of comes down to what you maybe get started with is what you stick with, because now that I've invested even just a small amount of 8 months or whatever it's been into R, I can't see myself changing, and I'm sure you feel the same. So.
Well, actually, I know R as well.
Oh, okay.
Because I'm now teaching a finance course at Northwestern University, master degree program in predictive analytics. They use
Nice.
R in their courses.
Right.
So I have to learn R, and I did. And so that's why I say I'm a pretty honest comparison. I can have an unbiased comparison.
Right. Nice. Good job. Okay, let's take a look. Iya is asking, how do you compute those exotic factors, and where did you find the free options data?
Options data are seldom free, I'm afraid. But the best bet is to try Quando.com. Let me type the thing here. Quando. Now, I don't know for a fact whether Quando has it. Quando, if anywhere has free data, Quando would have it. But options data is not easy to find free, especially historical. I mean, live option data is free on Yahoo Finance. But historical data is a different matter.
Right. Yeah, there's a good thread on BMT about Quandl that there's a lot of people that have already written to their API and incorporated. Like I just saw somebody write a NinjaTrader indicator for commitment of traders that automatically pulls the COT data. So there's a lot of things you can do with that API. It's really great.
Yeah.
Another question from Ilya. He's saying, hey, could you please do a massive open online course?
Oh, well, I don't know quite how to answer that. This is part of a fairly open course, I guess. Well, let me think about it. I will keep that in mind.
Yeah, I think there's a site out there. I don't know if I'm pronouncing it correctly or not. Coursera, Coursera. Okay, I see a lot of threads about them doing big classes from time to time. I'm not sure if maybe that's what he's referring to.
Right, right. Well, that's I love MOOC, don't get me wrong, but MOOC is usually given by esteemed professors in esteemed universities, right? They started by people, Harvard professor give a class and 2 million people view it, or Stanford AI professors went and 10 million people see it. They can afford to do that because they are paid by Harvard and Stanford. I unfortunately is an entrepreneur, and so I have to charge for what I teach. I don't get a salary from a university, so that's not really suitable actually for certain trainers.
Sure, I understand. Bob wants to know, does this apply to trading futures? I mean, you pretty much talked about equities today, or options on equities. What about futures?
They are there are factors for futures. In some sense, a simple thing such as roll returns, and basically return in, or some just return in some looked at period. That's a factor, and that's actually work pretty well for futures. So, and also particularly macroeconomic factors certainly is relevant to futures, right? So we know that in a let's say if you're talking about bond futures, obviously the the inflation rate is a important predictive variable.
Right.
So different futures will be very sensitive to different macroeconomic factors, particularly bonds or energy futures and some other.
Do you feel the same way about ETFs? I mean that if you're looking at ETFs instead of individual equities is what I mean, or if your goal is to trade ETFs.
Oh, okay. Yes, that exactly. Yes, ETF. There are many kinds. Obviously, for example, if you're talking about sector ETFs, right? So if you talk about consumer cyclicals, obviously they are affected by economic growth. They are affected by let's say interest rate. If interest rate is high, people might be unwilling to consume much because all their money is used to pay mortgages. So certainly again, macroeconomic factors will be very relevant to trading ETFs.
Right. Okay. All right. I don't see too many other questions that you haven't already answered. Hang on. Just got one. Roger wants to know if Ernie is using exotic factors for your own trading. I imagine yes, right?
Yeah, actually, I investigated each of these factors because I read them in a paper, and I immediately, go back test it myself to determine if it's suitable.
Right.
What I find often is that my conclusion often differs from what the researcher propose, and particularly with more recent data. So, and sometimes even though it does generate return, the Sharpe ratio is too low for my own trading, for my funds trading.
Right.
So remember I talked about, why is it the fact that these factors who are well known to have good returns are still there? Why is it not arbitrage away? It comes back to that question. The reason they are not arbitrage away is that they have long periods of drawdown. Then they might be very steep drawdown occasionally.
Right.
And that's why I don't trade them, because I can't afford to lose money for 3 years in a row.
Well, the first thing that came to mind when you said that you read the research and then you do your own and reach a different conclusion is that famous quote, lies, damn lies, and statistics, because you can make a paper reach a conclusion, really whatever conclusion you'd like. It's very biased from a lot of different factors, right? Even if they don't intend it to be. Yeah. So you have to be extremely careful when you don't just assume what you read is going to apply accurately to the way that you're trading the market, right? Okay, so I don't see any other questions, and we're at an hour, so this is a good point to go ahead and do the book. So before we do the 5 books, I just want to remind everybody that Ernie's going to read the question, and then we're going to have you type in the answer. Ernie will pick the best answer, and I will then ask for your BMT username, and I will get in touch with you after the webinar is done so that I can get your address and stuff to get the autographed books to you. Okay, Ernie, do you have the questions panel up so you can see the questions coming in or the answers coming in?
I can see the the questions panel. Right now I see a lot of questions there already, so I'm guessing that people will be typing in the answers on that
same one.
panel. Okay, great. Okay, so first question is, this is an easy one, by the way. Why is it less easy to arbitrage away a factor returns as opposed to the so-called alphas that hedge funds love? Why is it less easy to arbitrage away those factor returns?
Okay, getting some answers.
Let's see where. Yep, I think they are all correct. I think the first person who typed in the correct answer is Chris Jones. Is that not?
Okay, Chris, I need your BMT username, please. Okay, so book number 2.
Okay. Is inflation rate a cross-sectional or a time series factor for stocks? Okay, so it's indeed a time series factor, and I think Ear, if I pronounce it incorrectly, got the first right answer.
Yep, and I already know your username. Chris, still waiting for your BMT username. Please type it in. Okay, number 3, book number 3.
Okay, if implied skewness is positive, does that mean that options traders think the stock will break out on the upside? That's the first part of the question. Also, does that mean that OTM calls, out of the money calls, are more expensive than our OTM puts? Does that mean calls are more expensive than puts? Okay, so Mike, do you believe that BP is the one who got it first, if I'm reading correctly?
Yes.
Yes, is that? Okay.
Yep.
Yeah.
All right,
okay,
so BP, I need your BMT username, please. Okay, so book number 4.
Okay. Why do we sometimes have to build factor models for small cap versus large cap stocks separately? Why can't we just mix up, build a factor model for 1,000 stocks at the same time? Okay. I think the best answer so far is CB. Regression sign might change. That's the most precise answer, yes.
Okay, so CB, I need your BMT username, please. All right, and last book number 5.
Okay. What are the 2 ways to measure short interest for a stock? You can either give the acronym or just a few words. Okay, Stacy, I think, is fast and got the acronym correct.
All right, Stacy, I need your BMT username. Okay, let me write down CB's. Okay. All right, guys, so congratulations on winning one of the books, if you did, and I will be in touch with you in just a minute as soon as this webinar is over via private message, so please reply back as soon as you can. I'll send all the info to Ernie. He will help me out greatly by shipping these directly to you since I'm in Ecuador, and that would be quite difficult for me to do.
Okay.
All right, so Ernie, I really, really appreciate it, like always. Fantastic job, and I hope to see you back soon for another webinar, maybe early next year.
Okay, thank you very much for inviting.
Yeah, one last question. Any plans for another book?
No concrete plans yet. When I collect enough materials, typically it takes me 3 years to learn enough and did enough research to have
understood
material for book. So yeah, maybe another 2 years.
All right, sounds good. All right, guys. Thanks, Ernie. Thanks, guys.
Okay, thanks. Good night to everybody.
All right, bye.